All right, so welcome back to Multifamily Live. Welcome back. Great to see you guys. So excited to be here. I have a tremendous guest today, Stefan Tsvetkov. Hey, Stefan, how you doing?
Hey, Jason. Good. How are you? Thanks for having me.
I'm excited to have you on the show today because you come action-packed, data-driven. We know a lot of what you're going to get into here, so we can't wait to dive in. And a little bit about Stefan is he's the founder of RealtyQuant, a company that brings data-driven and quantitative techniques to the real estate industry. He's on a mission to add industry value through education, investment, technology, and analytics. Financial engineer turned multifamily investor, analytics speaker, and live webinar host. He's got a master's degree in financial engineering from Columbia University, and during his finance career, managed over $90 billion of derivatives portfolio jointly with his colleagues. Been featured on multiple podcasts, webinars, including Elevate, Best Ever Real Estate Show, The Apartment Guys, host of Finance Meets Real Estate webinar series, and welcome to the show. So we are ready to dive in here. Ready to talk market analytics. You hold yourself here in New York today. So give us a little more context. Talk to us about RealtyQuant, why that was the driver for you to move into this space and really take hold of what you're doing.
Yeah, absolutely. So like you mentioned, I had a career in finance before for about a decade. So I used to trade derivatives for a large financial institution. And I recently, in the past few years, 2-3 years, transitioned into the small multifamily space, in the New York City area. So I've been an investor. I've done 7 projects myself. I focus on condominium conversions, in places like downtown Jersey City, Weehawken, places like that. I'm sure you know the area well. You used to live in New Jersey, and I've been transitioning more into the commercial multifamily space recently and searching for my first deal there.
That's fantastic. Why the parallel from what you were doing into the multifamily space? What have been some of the key things you've been looking at that said, okay, I'm going to transition?
Yeah. Well, I've been like you mentioned, I've also founded I've been a real estate entrepreneur as well. So besides an investor, so I founded RealtyQuant, which is a kind of an analytics shop, an analytics company. So I did different modeling and analysis in the multifamily space, and so it kind of led me to naturally to this transition and having better understanding of various markets, having understanding of kind of how to model commercial multifamily value add quite off market at scale. So that's a model that we've been working on releasing as a product at my company. And so that kind of led me to, in the obvious scaling reasons that others have, it's easier to scale in commercial, etc. So that led me to transition into this space.
Noting that you've been doing projects, New York City, out to Weehawken, Jersey City, are you now, as you transition into the multifamily space, have you now transitioned to different markets, or how is this next step looking?
Yeah, absolutely. So for myself, and that would depend on everyone's risk tolerance, I would say, at this point in the market cycle. But for me, that's been more the Midwest. I mean, I've been working towards the South as well, so it's been Kentucky, Indiana, Ohio, places like that.
What have been some of the drivers saying that those are the markets we're going to go into? Our first large multifamily was in Louisville, Kentucky, and funny enough, our last New Jersey project was actually, I believe, in the Heights. So in Jersey City, in the Heights area. So we follow a similar track of where we've been and where we're going.
Right. I mean, as you well know, and I've listened to your content, Jason, as well. The Northeast is pretty depressed, and it's been really like that for a long time. Actually, if we look outside of the big cities like New York City, it's actually been for perhaps 70 years. With some of the manufacturing, kind of jobs leaving, back in the 50s and then 70s, etc. So it's really the Northeast, not having a high appeal for commercial multifamily is kind of, it's something that I'm sure many of your audience are acquainted with, and it's, investing to the South and West. But now at my company, RealtyQuant, so one thing that I did at the beginning of COVID, I did a study on market valuations. It's quite interesting since I know most multifamily operators, they pick markets on the basis of kind of appreciation potential. So you would look at job growth, population growth, etc. But what I actually did is kind of a study of downside risk and trying to understand, okay, what if what is the downside risk in all those markets in the event we hit like peak of cycle. And this is the concept of market valuation. So it's really to derive like, is the market, X% over, under, fairly valued, is it 10% over, and things like that. And so I did a study based on the global financial crisis at the time. And as you mentioned, I'm a financial engineer, like by background. So that kind of was like some of my interest. And I did it at the beginning of COVID. And it was interesting. It was interesting actually to see at the state level, if one took like affordability deviations, like it's a simple measure, like price income ratio deviations from historical levels, one would have predicted in magnitude, like the state level drops to like 85% correlation. So that's like quite interesting. So that's like one thing that, I use in my own investment. And then at RealtyQuant, we publish it as we have the data for the 2,700 US counties. And we say, okay, are they, like 10% overvalued, undervalued, things like that. And so Western markets for me at this point is just not exactly my risk tolerance. Now, I don't like discourage people from investing there, but especially, so I started, especially in 2021, some of those metrics kind of jumped up with inflation. And I can talk to that as well, since,
Sure.
Right. And I know like many investors, they would say, like, inflation is good for hard assets. That's definitely the case. It has brought like massive appreciation for us, for investors and operators at the current time. But it also can render your market overvalued at some point. So that's like some of the risks of when like asset inflation exceeds wage inflation. And so just to give like some numbers, I guess, like just
that's good, because what I want you to touch on that spot is that asset inflation, of course, increases past wage inflation, but like, and so the big through line there is that the prices, everything's going up, right? Rent, everything's going to go up in a point here, but people aren't making enough money to keep up, right? So although it looks good on the real estate side, everything's going up. Well, at a certain point, if you have a renter in there paying $700 of rent, now it's going to go up. You're going to try and go to 1,000. Typically, that same renter profile is not going to be able to say, "Oh, I'm good at that," right? Because they're living paycheck to paycheck, or their hours, like they're just not going to be able to make up that gap, right? So, talk more to that, because it's really interesting to hear that.
Absolutely. Yeah, absolutely. I mean, first of all, it's like, why does it matter? Let's say like the wage, sort of this kind of wages to asset disparity. Now, it sounds intuitive that if, things are very expensive, then people cannot afford it, but it's not like so obvious, because if you have like places like San Francisco and you have like, they're like very high or like very low, call it on the affordability index, like, and so forth, where, housing is really expensive relative to wages. And I don't know their exact like home price to personal income ratio, if it's 15 or it's 20 or so forth, but it's fairly up there. And so, but the importance of it is not in that per se. It starts to be important once it deviates from its historical levels. So, for example, when I was at some events like at the beginning of COVID, and I was sharing how San Francisco, even though like super expensive, and it wouldn't be a surprise since it's not an attractive market, obviously, at the current time, but it was actually undervalued. So it was actually undervalued, and that's in part due to the low investor appetite and the negative net migration in California and so on and so forth. But the reality was you have a place that is extremely not affordable, at a very high price income ratio, but that's not what's driving its potential downside risk. Downside risk in real estate seems to stem mostly from deviations in affordability. So when it jumps up above a prior level. And so now those deviations, some of them can be fundamental and meaningful, because if we take, let's say again, like using San Francisco as an example, and if it in the past, maybe in 50s or whatever, if maybe it had a price income ratio, like, and again, price income meaning home price to personal income over there of, let's say 5, and then gradually as housing shortage develops, like there's more and more housing shortage in the city, and that ratio shifts up, and then at some point it's at 15, 20. But again, that's if that happens in a gradual way, consistent with the housing population to housing supply ratios, then that's going to be like meaningful and fundamental, and that market is not overvalued. And that was the case for San Francisco at the beginning of COVID. So essentially, very expensive still, and very and it has a degree of housing shortage, but it's all metrics that are kind of reflected in the price, and even to a point that San Francisco is like 5% undervalued at the time. And I'm not sure at the current time, it's something around the same percentage, since it's obviously, it had even a negative trend obviously during COVID. But that's that's like some of the analysis there. And like to clarify, like in this study of downside risk, I looked at like different measures at the time. I was looking at foreclosure rates. Like if you know, like a company called Atom Data Solutions is like the main like foreclosure data vendor in the US. And I was looking at like other like price volatility, risk adjusted returns, things like that. They were not very predictive of downside risk. It's like I can give examples to places. If we use, for example, like some of the very poor states like West Virginia and so forth. So they have very low
foreclosure data was not predictive of downside risk.
Not predict. Yeah, that is quite interesting because I was that's quite interesting because I was looking at like even at the beginning of COVID, there were some articles. What are some places that have like the highest potential for downturn during the if COVID was to mark the peak of the cycle, let's say. Mm-hmm. And so which didn't happen, right? But so that study was looking at was actually showing some counties in New Jersey, and there was, for example, even Sussex County was up there,
Sure.
And then simultaneously was showing some counties in Florida and Illinois and so forth. But then in a broader kind of study, like the one that they do, like looking at more metrics, one would see that actually those are very different regions. So New Jersey is a place that is undervalued at the time. It does have it's been the top foreclosure state for a few years, like 5-6 years in a row. But simultaneously, it's not a desired region. It's undervalued. It's only Hudson County. It's kind of fairly valued. But the rest of it is pretty much undervalued. And those regions, they didn't drop even during the global financial crisis. So during the global financial crisis, there were 10 states that were undervalued. In fact, Texas was undervalued at the time. It's very interesting. And so Texas was 5% undervalued, and it experienced only a 4% drop. And actually, the 4% was the average drop across all those 10 states, which were undervalued. So it was really minor, really minor. And on the other end of the spectrum, there were places like California, Florida, Nevada, and Arizona, which dropped like 40 to 60%. But that was actually roughly the percentage of their overvaluation in affordability terms. So it's quite interesting. It was very well aligned. And there were people at the time, for example, I've spoken to Vinny Chopra at my webinar, who I know he did his first syndication in 2008, and it did really well as a project. But one reason is on the market side, let's say, other than being a good project, I'm sure the property itself on the market side, it didn't experience any drop. Like he was in an undervalued county in an undervalued state at the time. And that's a state that, as we know, has been one of the booming performers during the subsequent market cycle. And so that's been like interesting. And I can share also what I see now if people are curious.
I'd love it to fast forward to today, because I think it's really obvious. Of course, we've seen it play out, right? The Floridas of the world, the Texas of the world, we've seen it play out of how they've now transcended through into today. I'm curious, even with COVID, just the way that San Francisco was outlined. But you talked earlier about your move into Kentucky, into Indiana, right? And I'm curious why those are the driver markets. Like, what's pushing them as the key piece or the key recipe to say these are undervalued markets? And beyond that, of course, there's you spoke to New Jersey, where Hudson is really the driver in New Jersey. But in regards to, of course, a Kentucky and an Indiana, is it the state in general you're looking at, or like where, or specifically counties, or how are you dissecting this?
Yeah, no, of course, it's specific markets in those states. And I mean, like you mentioned, Wavio in Kentucky and so forth. But really, if we would take a broader view, the Midwest is currently, I wouldn't even say it's undervalued already. Like with inflation, it's kind of fairly valued. And then the Northeast is undervalued, broadly speaking. And then the South is overvalued, but not super much. Just like high level discussion. And then the West, specifically 5 states, I would say, like Arizona, Idaho is number one. So Idaho is the most over in this framework. And again, like this is just a framework, but that's a framework to keep in mind that correlated 85% to the actual declines past the global financial crisis. So now we can think it can be different now. It's possible.
Yeah.
And I can discuss like what could drive that, because global financial crisis was a complete correction scenario where basically every county almost in the country, like 85% of the county's price is corrected. And we can have a definition of what it means that they corrected, let's say above a certain percentage, like decline and so forth. But,
what's interesting is that because most of the time, the hardest thing right now is that we speak in all encompassing, right? And so, are we in a bubble? And the thing that many forget is that like we have we have all these states here. We have all these different parts, right? We have all these different moving pieces. You can't talk about this because you see it all. It can be on region, can be counties, can be local, can be national, right? So to talk now that we're looking as the Northeast, right? And with all of the movement out of it, all the negative press, all the push drivers actually looks to be undervalued. And then I would say potentially not surprising the West is overvalued. I guess you said Idaho. I would figure Arizona, potentially into California, and what would be the other two that might be overvalued, like a Washington?
California is fairly valued. That's the only, that's just because, like, so the negative migration and so forth.
Yeah.
Again, like, it's not a, like, if a place, and again, like I have this at the county level, one can do the zip code level as well, if one wants to put the work for it, so to say.
Sure.
But it's really, it's really, in Western markets, like I said, Idaho seems to be the leader at the current time. And if some of your audience listens to Neil Bauer as an example, I know he shared like Boise in Idaho is the best performing city this market cycle. So that's just price histories. That's easy to see. I do see the same actually. So out of like 800 cities with more than 50,000 population, Boise is at the very top. So that is correct. But at the same time, Boise was actually, even at the beginning of COVID, I was at some events where I was sharing that Boise was already overvalued, like about 30%. And it's actually has jumped to like 47% in this framework. And this is kind of a correlation study. It doesn't mean its drop is going to be exactly that high. It could be 30% on the same or something. It's kind of a correlation study. But again, it is the most overvalued city in this framework in the US.
So could it be that, we pick up, of course, 2024, 2025, we start looking at that, of course, supply starts to find its way back towards demand. Is it interest rates? What could find the biggest curve to change that, where we see the drivers that are pushing Boise today? What could we see that could have the biggest impact to change the narrative on what's happening in the market?
Yeah, I mean, just first thing to mention, so this is based on 20 years back history of valuation. So this is kind of a deviation from a 20-year history. So it's not a very trivial. It's not like something that just like happened instantly, but at the same time, yes, most of the contribution is just like very recent. And so, yes, to your point, what could change it? Well, if wage inflation could change it, for example, or population and, because, like some people would say, well, Idaho is exploding and it's really booming. That is true, but it could also be booming to the same degree to which prices are appreciating. That was the case in Denver. So Denver at the beginning of COVID was a top 5 performing city. And actually in the same study, it was at 0%, was fairly valued. It was like, if I was living in Denver, I would be thinking, well, that's like a crazy bubble. Prices have exploded here. But actually, it's fundamentals. And when I say fundamentals, it's really at least to the, like every study is limited to the extent, right? So to the extent of the study that I'm doing, it's really fundamentals are income, population, and housing supply. So in those three, so Denver at the time was fairly valued, and it's gone like with inflation a little bit overvalued now. But still, it's a very different dynamic. And so with Boise, it's really like if wages catch up, if all the fundamentals, or if population to housing supply ratios, they move in a correspondent way that some of that overvaluation resolves. Now, there are different scenarios. It doesn't mean it's going to correct. It's not like doomsday and so forth. It's, by the way, Boise is also my top 1 year forecast. I also do some price forecasting like that for myself. And so my 1 year price forecast is the highest for Boise too. So I'm not bearish on Boise. If we stay in the same market cycle, those overvalued markets are going to do the best. That is what the data shows, because that there's momentum. So like all those Western markets that are doing really well, they will continue doing really well. But simultaneously, they have this downside risk that they carry. So then that becomes a question. Yeah, just becomes a question now. What's your risk tolerance? Do you want to go? Well, let's take Arizona as an example. So Arizona in 2021, or Phoenix. So let's say in 2021, inflation really spiked, as we know. Sure. And so in the first half of the year, Arizona prices at the state level were up 16%. For Phoenix, even more. And we heard like, oh, the rent growth and like it's been an extremely profitable time, right? And the rent growth also double digit, etc. And so, but incomes grew by 1% only in the first month. So this is kind of, it becomes an issue. And Arizona valuations that were actually around 15% for the past 4 years, since 2017, they kind of doubled and they went to like 30%. So that's been what's happening in 2021. Because I was at the beginning of COVID again, just because that's kind of when I started with this thing. When I go to an event, like my narrative was US real estate is fairly valued. And to your point, of course, every different market, state, etc. is different. I agree. But if we make like a broad statement for US, was kind of fairly valued. It was actually consistent with some other studies. There's a study at Florida Atlantic University. There is a study by Bloomberg Economics. So Bloomberg Economics, they publish a study for different countries. And they were showing in 2019 and up to the beginning of 2021, in fact, US real estate is fairly valued. And there was Canada, it's very overvalued. Canada is kind of seems to be in a bubble in a way. And then there was Scandinavia, like Sweden, and then New Zealand and Australia. And then to some extent, but the US was a different story. And it was even somewhat consistent with investor intuition. We were never seeing something. I mean, people will complain, oh, we can't find deals. It's hard to find deals. There's this narrative even in the Northeast, which is strange, right? Because the Northeast is undesired. It's, it's not like a place where people want to be, but people feel that even the Northeast is perhaps overvalued, which is not correct. And so there are those narratives, but it didn't feel as a bubble as, this kind of very high, like extremely high appreciation. But in 2021, this changed. And it's another example, let's say Texas and Florida, right? So the main multifamily markets can say, like the big states that for multifamily. So they were valuations in that framework are pretty consistent. Usually in normal times. So they stayed between 2017 to 2020 for 4 years, quarter after quarter. They were always within the 8 to 10% range, positive. Their desired market, so they were kind of like slightly overvalued, call it, but there's no, it's like normal kind of valuation, positive 8 to 10% for 4 years consistently. And now in 2021, and that's nothing like doomsday and so forth, since I'm an investor myself, I'm sorry, I don't want to kind of the market to not do well, but in a way, in 2021, it was doubling of those numbers. So they went to like 17, 18%. And so that's been like some of the contribution of inflation. The one way it can resolve is if wages catch up, like we said. So I'm kind of hoping for that to an extent, like it seems, but the recent data by Bureau of Economic Analysis came out for the last quarter of 2021, since it's kind of lagging by a quarter. And so it came out and it's again 1% income growth. Mm-hmm. So it's not doesn't seem to be there. And the prices in Florida in the last quarter, the price growth was 5.5%. And it's just 1% income growth. So that's going to drive it even further.
When you recap this, it's so interesting, but when you think of it in common sense, right? If everything keeps increasing, we can't keep up with the wages. It puts us in such a hard place for seeing this continue to drive out, right? And right now, from a holistic point, looking at, of course, the Midwest, right? We can find our value, the Southeast. If you want more risk tolerance, right? We still potentially have a lot of runway that's going to continue to happen on the West Coast. However, you have, of course, the inherent downside risk that is imposed on it. And then the East Coast, funny as enough, as it looks right now, even though no one wants to be there, right? It is in its own way undervalued, right? And typically that's the point, right? It's that you run from the fear section right now, but ultimately, usually you see a lot always come back to those areas once people snap out of it, right? And a lot of things have always run off New York City. And so it's hard to ever keep New York City down, as they say it. So, Stefan, this is truly interesting. I love hearing how you're building this into you and your business and really just your philosophy on investing. For everyone that would love to connect more with you, learn about RealtyQuant, see your webinars, what's the best way to reach out and find you?
Yes, yeah, and it's been a pleasure, Jason, as well. So the best way to reach me is my website, realtyquant.com. Also, I have a YouTube channel, Finance Meets Real Estate on YouTube. Those are the best ways.
Nice. Well, Stefan, thank you so much for coming on the show, sharing all this great data, gives the listeners just a ton to think about, a ton of perspective for you as you are looking into the future, into where you're going with your investment philosophy. Thank you to all of you for always listening. Like what you hear, please go down there and hit that subscribe button. Give us a like and follow. We always love to hear from you. We'll talk to you shortly.